Hello, everybody. So as you may know, on Fridays, I typically analyze all of the stocks in my universe, and I've gotten used to kind of comparing those stocks and looking at which stock is the cheapest right now, which stock has the cheapest growth. My type of investing is really to try to invest in companies that have products that are at the early signs of product adoption, and to try to kind of get out and sell those stocks once the growth for those companies normalizes and gets closer to the rate of the economy. So I try to look for the best hyper growth stock, the best growth stocks. And as I've done a lot of videos now, every now and then I get a comment from my viewers telling me, oh, you should check out that stock, check out this stock. And I have kind of a list. And I went through the list and took 3 names at random today. And I will briefly talk about them and analyze them. And this is this video, right? So this is not a full analysis of each stock, but just my thoughts on each stocks and where they stand at their stage of development and wherever I find them interesting. What are just my general thoughts about these stocks? So the first stock that one of my viewers recommended is Allbirds. So Allbirds, well, first of all, let me say I know very little about the shoe business. I don't know much about it. I know that this is clearly a lifestyle brand from what I can see, and it's a growth stock, so it's in my alley. And I remember those being popular in the US, but I know there's many knockoffs on those. And actually, what I find strange is that the brand is not visible on a lot of these shoes, and so I think it may be hard for people to tell apart which one is the real one and which one is the knockoff, but it's a common problem in fashion. And who is this brand targeting, right? So they have more female consumers than men, people in their mid-30s, adventurous, active, care about the environment, positive impact, people who care about premium brands. They're actually expensive. They're more than $100. So this is kind of a type of customer. So I'm not sure I fit the criteria here, and so hence sometimes my inability to understand some stocks. Right, you can't understand them all, and this is what they have. They have very high net promoter score. Well, yes, but they don't tell us what it is. So I'd like to see what it is. And to me, this is clearly a turnaround play, because even if they have loyal customers, they want to improve and reconnect with the core customer, and their growth has kind of stalled. And so I think this is a turnaround play in the lifestyle sector, and clearly this is a product that I do not understand, that I can't relate to, perhaps not as much as my other lifestyle stocks, mostly because shoes, I really don't understand shoes. I've never really understood why people spend a lot of money on shoes, like Nike, for example. Nike is a stock that has always eluded me. I'm like, I don't understand why people spend $700 on Nike. I just have a predisposition to have a hard time understanding the shoe business. So, but that's okay. Let me see more. So when I look at the performance of the stock is down 85%, which is crazy for me to say, but it's not that bad actually. I mean, I've seen way worse. I mean, remember, I own Open Door, so I've seen way worse than 85% down, and it looks like they've had a big drawdown over the past few months, but nothing, I mean, that would not be a condition to be out of the stock. What I care about, though, rather than stock price, because right now they're all correlated, and anything innovative, anything that tries to do anything innovative and growthy is going to be down, and I have a chart like that, plus or minus 20% right now. But I like to look at revenues. Revenues matter much more than stock price. And when I look at revenues, I agree with them, right? In their investor presentation, they say they need to reconnect with the consumer. Well, when I see those sales, I understand. The sales have stalled. They're only up 7% year over year. And so that's well below my threshold, and that's what I say, like, better be cheap. The stock better be cheap, and this stock does not disappoint, because it is cheap, as I'll show you here. So the revenue last year was 298 million, right? Nothing to sneeze at. I mean, for a shoe brand, that's pretty high, right? Keep in mind, these are recent companies, like these are recent IPOs. So the fact that they got to this level alone is impressive. They have something going on, right? But the analysts are expecting the growth to keep stalling at a 1% growth next year, from what they say. Now, what I find interesting is for 44% gross margin. I think this is very low, and I don't know if this has something to do with their mission and how they give give back. I believe I saw a few things on their website about them being a B Corp and giving back. And so 44% gross margin, that seems pretty low to me, especially when I compare to a stock that I follow on the channel, which is Figs in the clothing, lifestyle clothing sector. They do clothes and they have 70% gross margin. So does that mean that the shoe business, that it's inherently harder to make shoes? Is that what it means? Or does it mean that a good share of that gross margin goes towards perhaps less than optimal operations? So I'm wondering about that. But that's okay. So we can calculate next year's gross profit estimated. That's going to be 132 million. The enterprise value of this company is dirt cheap at 97 million enterprise value. So they have 106 million of debt and 165 million of cash. So of course the debt is not a problem because they have cash above that debt, and that would give them an enterprise value to gross profit to forward gross profit of 0.73. So that is absolutely dirt cheap, because in my universe the average enterprise value of a forward gross profit is 11. So that is absolutely dirt cheap. It's three times cheaper than Figs, for example, and Figs is one of the cheapest in my universe. But here's why. Here's the problem. The negative free cash flow is minus 84 million over the past year. That's the problem. And so yeah, they have about 2 years of cash right now at this burn rate, but they better do something about the burn rate. And companies are agile. Like I don't doubt that they're going to do something about this burn rate and make sure to not burn as much in the upcoming 2 years. But to me, this is too hard of a stock, because since I'm not a consumer of the product, I don't have intimate knowledge as to whether this product is actually going to see a spike in sales, right? If this stock were to do 30 or 40% in sales next year, that might be a very interesting stock to look at. But analysts are predicting, not that I trust analysts in any way, but when I look at the trajectory of the revenue, it seems like the revenue has stalled. They also say that they're going to be very careful about capital allocation towards their stores. So maybe they're going to have not as many stores that they had hoped. So anyways, this is clearly a turnaround play. I believe if someone knows this brand very well and is a believer in the brand and studies the brand, I believe this could be an interesting play. But for me, it is too hard for me. Okay. Let me move on to the next stock that was recommended by my viewers. So what is the next stock? The next stock is BEEM, ticker symbol BEEM. And so this is truly a micro-cap stock swimming in an enormous blue ocean, which is the EV and the EV charging space. It's a very tiny company, right? 130 million employees. They have one facility in San Diego that has tremendous room for growth at 20x growth possible. They're addressing a problem with the grid. Sometimes it's tough in some areas to get connected to the grid and to have backup power to charge your EVs. So this is kind of a problem. By the way, they do these car ports that you can just deliver and put in a parking spot, and you don't need to have any infrastructure. It's all independent. And I think their motto is pretty good here: drive on sunshine. It's all independent. This whole unit gets on a truck and is delivered on a parking lot, and then the cars can charge by parking near to that unit. So that's the business. They have no debt. That's good. And they're really going after the traditional ecosystem of setting up charging stations, right? That's what they're going after. And so, for example, when I think about that, I think one of the negative points of that, for example, is the superchargers, right? The Tesla superchargers are opening up slowly to everybody with an EV. So I think, for example, that would be a headwind for this company, because all of a sudden the Tesla superchargers, which is the biggest network of superchargers, is going to be available to anybody with the app. So I think there's a few headwinds, but nonetheless, my analysis of this company, you'll see, will take an interesting turn, because when I look at their revenues, they're obviously what I'd like to call proof of concept type of revenues. Like, these revenues are too tiny, right? This company is very, very, very early. They've also announced a recent acquisition to acquire a thermal management system, and so they've bought this company Allcell that is going to help them with their thermal management of their batteries. They also get a little diversification of revenue, a little bit of dilution from what I saw, maybe 10% dilution, but nothing too concerning. That's a small acquisition here, but noteworthy that they do some growth by acquisition, so that's noteworthy because I prefer organic growth a little more. What's a nice positive? There's positives for this company. A big positive for them, for example, is that they have $62 million of contracted backlog with purchase orders in hand. So that's a nice positive for a company that's in such an early stage. And I think what's more impressive is and they promote this. They know it's a big deal because they promote it all over the internet. When you look up for them, is they did sell the product to the United States Marine Corps, and so this is a good proof of concept for me because that's an elite institution and they're like buying that product. So that means that's a very, very positive, and I understand why they promote it all over. But like I said, the company to me seems in an early mode. They are developing their product. They are investing heavily in the product, like a lot of companies do in the very, very early stages. They're in R&D mode. They're looking at the all-cell product, a solar tree, EV streetlights, drone rechargers, bike chargers. They're kind of looking for their way still because they are a very, very early company. The main product that they sell is the EV arc, which is what you see here. And so, based on that, I find it interesting that this company, the stock price has been doing very, very well. Like the stock price is essentially flat, which tells me that this is a company that is trading based on its potential. It's a company that is trading based on how large the total addressable market could be. Even if you look at the spike, if you go on Google and look at the stock chart, you see like it spiked quite a bit, but it's only down like 80% from the top of that spike. And actually, if you go back down to the 2019 when it was trading, the stock is up. So this is a stock that has been very, very resilient. I can see that this stock has a lot of faithful followers and backers. One more good thing about the stock, they expect 99% revenue growth, which is excellent. But, and this is where what I'll say is I cannot analyze this stock. I can't analyze it. I can't have an opinion on it because it is too early for me. It's a negative gross margin stock, right? If you look at their trailing 12 months, they had 17.6 million of revenues and their cost of revenue was 18.9. So they have negative gross margin. And this is where all of my analytical lens, kind of falls apart because I don't invest in companies that are not optimized for gross profit. And, even if one were to say, you could use price to sales, but, I think price to sales for this company is not the appropriate metric either. They're clearly in the R&D stage. If you ask me, this is probably a company that IPO'd too soon. Probably the way I look at it. But then again, if you got to raise capital, you got to do something, and they decided to do an IPO. I think a lot of this company is trading based on how big they could potentially be because their total addressable market is enormous, and they spend a lot of time talking about the total addressable market, but it's an entirely different type of investing than the type of investing that I do, where I invest in companies that are at least optimized for gross profit. The company has $5 million in cash and a $10 million free cash flow, which means to me it's cutting it close. So they're going to have, in my view, to either cut costs hard or do some sort of capital raise. And given how well the stock is holding up, I wouldn't be surprised if this is a company that did a capital raise, because when you look at the stock, clearly this company has a lot of backers. So again, I'm very, very neutral on this company. I'm neutral. It's not even too hard for me. It's just that I'm neutral because I don't analyze pre-gross profit companies. Period. It's just not something that I know how to do. This is something that, say, a VC, a venture capitalist, would be very good at analyzing this. Anyways, let me move on. to the third company, which is the gem that I talked about in the thumbnail, which I think is a gem, and I'm very thankful for one of my viewers for recommending this to me, which is Indie Semiconductors. So I love just about everything about Indie. So Indie is a silicon not silicon manufacturer, but it's an ASIC, application specific circuits. They make ASICs, application specific circuits in the semi space, and they develop these products for the auto industry, namely the auto industry that has to transition to electric cars, right? So all of the legacy players, you see, they put BMW a lot, but that's I believe that is Mercedes. That looks like a Mercedes right here. All of these legacy players are in need of new chips, and this company is a company that focuses on developing these new chips and selling these new chips to the auto sector. So just like NVIDIA is selling a lot of self-driving hardware and self-driving software and development, and is helping the legacy auto with self-driving, Indie is helping the legacy auto with kind of a new OEM, a new supplier of equipment that go into the vehicle, of silicon that goes into the vehicle. And they're predicting, this was a great chart, I believe, that today you have about $700 of vehicles, and as cars, and this is one of my fundamental beliefs about cars, cars are becoming smartphones on wheels. And as cars are slowly becoming smartphone on wheels, we're going to trend toward multiple thousands of dollars per vehicle in the future. And so this is a company that is definitely riding a mega trend. This is a company that is enabling a lot of the legacy players to compete against the elephant in the room, Tesla. But part of my thesis when I see the competition, say, of BMW, legacy auto, and all sorts, is I think they're going to have to give a good share of these profits that come from competing to suppliers like Indie, to suppliers of self-driving products like NVIDIA. That's I believe a fundamental reason why you'd be interested in this stock, because this stock is getting paid no matter what. Like no matter the success of a vehicle, this stock is getting paid, and legacy auto will sell electric cars. I believe electric cars are a superior technology, period. All electric cars will get sold. They will find buyers. The question is the legacy automakers going to make some money? You'll see that it's not that hard of a question for Indie, because Indie is going to make money on this from what I see. So when I look at the number of Indie, I see that they've been growing through both in-house development as well as through acquisition. Now, I don't like acquisition, but in the semi sector, it's true that acquisition is much more common and much more accepted, and also much more successful. If you look at, say, a company like Broadcom has had an uncanny ability to be successful at our acquisitions. So I just want to point out that typically acquisitions are bad, in my view, but in the semi space, acquisitions have typically panned out pretty well. So I just want to point that out. But they grow both, right, through organic product development and acquisition. Oh, there you go, a la Broadcom. I didn't even notice that. A la Broadcom, they've been doing it like Broadcom, right? Broadcom is the best example. Like the one outlier of one company that has been doing acquisition so well is Broadcom, and so of course they would use that example. But it's in that same industry, right? And Broadcom is very, very deep in the ASICs as well. And when I look at their revenue growth, it's been stellar quarter after quarter. We don't see any stock slowdown quarter after quarter, and they've been increasing their gross margin quarter after quarter to a mind-boggling 52%, which for a fabless chip manufacturer, right, is for a fabless chip company, this is amazing. This is very, very, very high. So I am impressed. I think they're probably charging an arm and a leg for these products to Legacy Auto. I am very impressed, actually. And let me go through my numbers, right? So first of all, revenue growth, and I'll have to dig deeper because I'm gonna do a full analysis on Indie because I like those numbers. Right now, I'm just using the analysts. The analyst number are saying 102% revenue growth over the next 10 months. That's a big green flag. That's wonderful. I'll have to dig and look and decide for myself what I think the revenue growth is, but this is amazing. Trailing 12-month revenue, 111 million. Next 12 months, 225 million. The gross margin, as I said, 52.2%. Amazing for that space. That would mean the forward gross profit would be 117 million. Enterprise value is they have some debt, but they have much more cash than debt. So their enterprise value is 1.33 billion. Debt is not a problem here because they have so much cash. And so when I calculate, I get an enterprise value over forward gross profit of 11, which is right at my average. But because of that insanely high growth rate, the company now is dirt cheap based on what you pay for that growth, based on enterprise value over gross profit over revenue growth. I get a 0.11, which tells me that for each % of growth, I am paying very, very little for that stock. And actually, when I compare it to my spreadsheet that I publish every Fridays, you can see that the only stock that is below that is StoneCo. That's the only stock that is below that. HIMS is trading at about the same valuation when you adjust, when you calculate the cost of growth, which is what matters to me. How much am I paying for that growth? Indie, I'm not paying much for the growth of Indie, so that's why I'm going to study a lot. I think Indie is very cheap right now. Totally cheap for that level of growth. This is a stock that has been flying under the radar. Interestingly, when you look at the chart of Indie, it has a chart that is very, very, very similar to the chart of HIMS. Sold off tremendously after the what is it? I'll call it the growth stock crash, and then slowly going back up. It's been slowly going back up past the $10 mark now. So I think Indie is very interesting. This is the gem. I will make a separate video on Indie as soon as I have time. So anyways, thank you so much for watching. This is not investment advice. This is just entertainment. Please give me in the comments any ideas for stocks that you're looking at, stocks that you like. I'll make another video on other stocks. So don't hesitate to drop some stocks for me to look at in the comment. Appreciate your likes and subscribes. Thank you and have a wonderful day.